strategist at CFC Seymour. He joins us now from our studios up in Hong Kong. Darius, good to have you with us. What do you make of this news that China's moving closer to launching stock index futures?
Well, of course, it's an important step in the development of the capital markets there, but I'm not sure it will be positive for the spot indices, because it will be a tool to actually short the market, which was lacking in the system so far. So I think that actually this kind of financial instrument introduced in the Chinese market may provide some downside when investors learn to use it.
Okay, futures a tool to, or stock index futures a tool to short the market. So you don't think then that investors are going to be piling into blue chips as a way of hedging against futures?
Well, there could be some potential for that, and blue chips, of course, are always the prime destination of capital, especially in riskier times. And we are in somewhat risky times because valuations are high, and there's a lot of IPOs in the pipeline in August. But because of the new supply of stocks, I think that possibly we are close to a peak for the third quarter in the Chinese stock market.
We're close to a peak. How much of a correction would you expect? How much downside in terms of percentage?
I think not very much, maybe 5%, 7%, something like that, but not more than 10%.
All right, 5 to 7%, so it's just a little bit shy of a true correction there. As a strategist, what are you thinking then after this correction is over? What should happen?
I believe that we will see further gains in the market in the fourth quarter of this year, and the new record highs will be seen close to 5,000 for the Shanghai Composite Index by the end of the year.
Okay. All right, Darius, stay right there. Come back and talk more in just a bit. Darius Kowalczyk, their Chief Investment Strategist, CFC Seymour. Continue talking to him after these quick words. We are 3 minutes before to kick off for Shanghai markets. Get to the open and early movers. Next on Squawk. Don't go away. He is Chief Investment Strategist at CFC Seymour. Darius, how do you see the Hong Kong market shaping up? I'm looking at some, just a little bit of the commentary here saying that investors really don't know what to do with the Hong Kong market. On the one hand, you still got lingering worries about subprime. On the other hand, though, local fundamentals still look pretty solid.
I think that the Hong Kong stock market, just as is the case for the whole Asia, presents an outstanding buying opportunity now that valuations have come down so much in the recent correction. In particular, Hong Kong stocks will benefit from the very likely rate cut in the fourth quarter by the Fed, which of course is very closely correlated to what's happening in the money market here in Hong Kong. So I would be a buyer both of the local stocks and of equities across Asia.
Even if there's a higher likelihood now that on the China side, post those July CPI numbers we had out yesterday, up 5.6%, the highest in about 11 months, about a year, there is an increasing likelihood now that tightening could be around the corner. We've got the English language China Daily suggesting as much in commentary today.
There has been 3 tightenings so far this year in China, and they haven't really dented optimism of equity investors either in the mainland or here in Hong Kong in any lasting manner. In fact, we should point out that the current jump in inflation in China is very similar to what happened in 2004, where CPI peaked at 5.3%, just below 5.6 now, but a similar level, also due to a jump in food prices. And back then, the central bank raised rates only once. This year, they have already done it 3 times, so I don't really think that it's certain at all that they will move up again. If they do, it will be only once more, so I don't think it will be really something that will scare investors.
Really, even though the rhetoric coming out of various newspapers in China and even senior government and PBOC officials is all pointing to the fact that a lot of people feel in China in official circles that they've entered the danger zone in terms of economic indicators, and that there needs to be some kind of urgent measures taken to prevent overheating.
Remember that we have heard this kind of comments for years already, so I don't think that anything unusual is happening this time. As long as inflation ex food is low and it is below 1%, I don't think that policymakers will be very worried. And a lot of the commentary in the Chinese media is something that you shouldn't really pay too much attention to, because there are all kinds of voices coming from various government-related economic research institutes. What you should pay attention to is the central bank, and they don't seem as alarmed as the media does.
I want to just take you back to a comment you made a moment ago, Derek, and that was about the fact that indeed Hong Kong could benefit if the Fed decides to go ahead and cut rates because, of course, the Hong Kong dollar is pegged to the US, so they might follow in the monetary policy cycle. We certainly saw property plays in Hong Kong benefit yesterday on that hope. And yet I'm wondering, there are some people who feel as if property is peaking in places like Hong Kong, also here in Singapore, that perhaps we might go the same way as the US housing market has gone.
Well, housing markets are always localized, at least to a much larger degree than other markets, just because of the nature of real estate. There has been a lot of divergence between, Western developed countries and emerging markets or markets in economies which are growing very fast, and Hong Kong is one of the latter. Besides, when you look at salaries of services professionals in Hong Kong, they continue to rise fast enough that I'm not really worried about the property market here.
So bottom line, you don't think that we're peaking out in Singapore or Hong Kong for the property market, despite the market volatility that's going on, despite potential further stock market losses?
Not in Hong Kong. I'm not looking into the real estate sector in Singapore, but in Hong Kong, I wouldn't be worried about that.
Yeah, are you worried about maybe tomorrow? We've been talking about this Wednesday deadline over in the U.S. for investors to say, look, I want out of my investments in hedge fund for the third quarter.
This clearly is a risk. However, I would say that a lot of the bad news has already taken place, and a lot of the concerns over what happens when tomorrow's deadlines comes in is already priced in the market, simply because investors are so uncertain. So that's why they have reduced valuations of the riskier investments or investments that could suffer from those withdrawals. And I think that after the numbers are announced, we will see a rebound in those risky investments, including equity markets.
Okay, you sound rather bullish. Well, I certainly hope that you're right, Derek. Thanks very much for joining us. Derek Kowalczyk, Chief Investment Strategist at CFC Seymour in Hong Kong. Now, coming up, just a reminder to